break-even analysis here is performed to determine the value of a variable of a project that makes two elements equal. For example, sales volume that equates revenues and costs. The analysis of break-even is based on the relationship that profit is equal to, look at this equation carefully, guys, that profit is equal to what? Total revenues. Total revenues would be like total sales, right?
Right.
Sales, take away total cost, or simply revenue R, we could say total revenue, take away total costs. Thus, at break-even, there is no profit or loss, which means that at break-even, total revenue is equal to total cost. So when you say you want to find, or we could say R equals TC, revenue equal total cost, right? When you say you want to find the break-even point, what you really want to find is the quantity of product that a company needs to produce and sell in order to ensure that the total revenue equates with the total cost. So that's what the break-even quantity is, guys. The break-even quantity is saying at that level of output, the company will be collecting the same amount from sales as what it costs to produce and put those products into the market. So when the total revenue, again, you could look at total revenue as total sales, equal to the total cost of producing the items that is being sold, items that are being sold. Why is this point so important? This break-even quantity, why is it so important? Well, the break-even quantity, guys, is so important because a company needs to know what its break-even point is in order to ensure that it knows what it needs to produce in order to make a profit. Let us say, for example, that we calculated that the break-even point for a company is 50 units. Let's say this is a beer producing company, right? Let's say this is a beer producing company. And we have calculated that the break-even point for the beer producing company is 50 bottles of beer. What would this 50 bottles of beer mean? Well, it would mean that if the company produces and sells 50 bottles of beer, the total revenue will equate with its total cost at 50 bottles of beer. That's the break-even point. So what if the company therefore sells 51 bottles of beer? The company would be what? The company sells 51 bottles of beer, what will it be making?
Profit.
That's profit. We'll be making our profit. So already we have derived one of the reasons why knowing the break-even point is so important. Because knowing the break-even point informs the company in as far as how many units of product to produce in order to start being profitable. Or we could say it tells the company how many units of product it should not fall below in order to ensure that it continues to avoid making a loss. So if the break-even point is 50, the company should not fall below producing and selling 50 units of product. Otherwise, it will be making a loss. If the break-even point is 50 units of beer, but this beer producer is producing 40 units of beer, then what would you say about this beer producing company? It is currently making a what?
A loss.
Currently making a loss. So producing less than the break-even quantity will put the company in a loss producing position, and producing above the break-even quantity will put the company in a profit making position, and producing the break-even quantity itself will put the company in a position where it is neither making a what? A profit nor a loss.
Profit nor loss.
Are you with me there so far?
Yes, sir.
Good.
Sir.
Yes, go
That's
ahead.
interpret that, but that's all like microeconomics to me, you know.
So yeah, it's somewhat.
Okay, sir.
Yeah, somewhat. And for the accountants, cost and managerial accounting does cover
Okay,
some
sir.
elements of that for the. I know there are a lot of accounting students in the group as well, and practicing accountants. Go ahead, Richard.
Yes, sir. So even though the break even
Mm-hmm.
is a marker, right?
It's a marker. Mm-hmm.
And if you meet break even, you just
Mm-hmm.
said you will neither lose nor gain.
Correct.
But thinking on it more rationally,
Mm-hmm.
what about production time?
Production
Wouldn't you
time.
lose production time
If you do what?
if you break even?
Mm-hmm.
Basically, remember,
Mm-hmm.
whether you break even or you go over the threshold, you will still
Mm-hmm.
have to consider production time.
Yeah, but the production time would have influenced
What
the
up in the cost?
cost.
Cost.
Yeah. See what I
Yes,
mean?
sir. So
Yeah. Mm-hmm.
the production costs, we take it into effect, all your direct costs, your
Yeah.
production overheads,
Mm-hmm.
and any work in progress.
Correct.
So those will factor into your costs.
That's correct, Craig. You with me there, Richard? And are you with
Yeah,
Craig there?
okay, okay.
Yeah. Yeah. So it would have been captured, it would have been measured, because it would have a direct, as Craig said, it would have a direct influence on the production cost. So therefore, it would have been, we could say, indirectly already factored in to deriving what the break-even point is, because it would have influenced this element in particular. And you will see that a little bit more clearly when we look at the composition of costs right here. So it says with revenue and costs given in terms of a decision variable, the solution yields the break-even quantity for the decision variable itself. Costs, which may be linear or nonlinear, usually has two components. By linear and nonlinear, we simply means when two things have a linear relationship, the relationship can be described by a straight line. Put in layman's terms, that means that if two things have a linear relationship, then in a very precise way, as one variable goes up, the other one goes down, or as one goes up, the other one also goes up. Strictly.
Proportionality.
Yes, there's a strict functionality along the line, right? So it wouldn't be if the relationship between two variables is such as sales and advertising expenditure. Let's use sales and advertising expenditure as an example. If the relationship between sales and advertising expenditure is linear, it wouldn't be that over a span of time, over the span of time that we're measuring, it wouldn't be that sometimes they go up together and sometimes they go down together, or sometimes they both remain fixed. It would have to be strictly a situation where they either increase together or decrease together, which is what we call a positive relationship, positive linear association, or that as one variable goes up, the other one goes down. That's also strictly speaking. So if one variable goes up and the other goes down over the period of measurement, and that's the only relationship that is observed, then that's a linear relationship. Or if one goes up and the other also goes up, strictly only that observed over the period, then that's a linear relationship as well. But a nonlinear relationship doesn't follow such functional straight lines. Nonlinear relationship could be modeled by a curve like this. So over a span of time, the variables are experiencing different directional associations. If over a span of time, the variables being investigated are experiencing different types of relationship over the span of time, then that's nonlinear. Linear would be like strictly this. straight line going up, or strictly this, straight line going down. But if you have curves, a curve that represents a relationship between two variables, the curve is said to represent a non-linear relationship. So linear suggests a straight line relationship. Non-linear suggests typically a curve relationship between the two variables. Okay, so just to explain what we meant by linear and non-linear there. So costs may vary linearly or non-linearly. Usually, cost has two components: fixed costs, which may include like building rentals or land rental, insurance payments. Those would also be considered to be fixed costs. Basically, fixed costs are costs that remain constant in the short run, regardless of the changes in production, in the level of production. We could look at fixed costs that way. That regardless of changes in the level of production, fixed costs do not vary in accordance with or vary directly with changes in levels of production. So production levels may be changing, but your fixed costs remain the same. So for example, guys, you might have insurance premiums to pay annually. Those insurance premiums that the company pays will have to be paid whether or not the company produces. Whether or not the company uses the warehouse that is insured, the insurance payments still have to be paid, right? So the insurance payments there would not vary in direct proportion to or in proportion to the level of production. And so insurance premiums would therefore be considered typically as a fixed cost. Any cost that does not vary directly with level of production is considered to be a fixed cost. Right? Insurance, your rent, you still have to pay your rent even if you did not use the building. So it's a fixed cost. Right? Fixed overheads, equipment, capital recovery, etc. These costs are essentially constant for all values of the decision variable. So where there is variable. I'm sure why it came out like this. For all values of the decision variable. So regardless of the level of output or level of production, the fixed cost remains the same. That's what that means, guys. Regardless of the level of production, the fixed cost remains the same. And then you have variable costs, which is the other component of total costs. Variable costs are costs that vary directly with the level of production. So we say these costs change linearly or non-linearly with the decision variable, example, production level or workforce size. Okay? So common examples of fixed costs include variable costs includes like raw material. In order to increase your level of production, you're going to have to increase your raw materials, isn't it? So your raw material costs will vary directly with the level of production that you undertake. Your direct labor costs will also vary with the level of production that you undertake. Typically, if you want to significantly increase production, you will have to increase your labor force. Right? That's right. You'll have to increase your labor force in order to increase production. That will increase labor cost. So direct labor, raw materials, those are good examples of variable cost. Marketing and advertisement cost will normally vary with the level of production that you're doing. These are variable, right? Cost of employing contractors, right? For the analysis below, we generally assume that the variation between level of production and cost is linear. For simplicity, we make that assumption, okay? So we're assuming a linear relationship for simplicity between the level of production and cost. Then it stands to reason, guys, that total cost would be equal to what? Fixed cost, FC, plus variable cost VC. Or we could put a T in front of these to say total fixed cost plus total variable cost. Do you get that, guys?
Yes, sir.
Yes, sir.
Yes,
Yes, sir.
Awesome.
Yes,
All right.
sir.
Yes, sir.
These are the two critical components of the variable of the total cost, the fixed and the variable cost. One changes directly with the level of production, and that is variable cost. One does not change directly with the level of production, and that is your fixed cost. Now, break-even analysis is used in businesses to study association among costs, volume, and profit. It determines the possible profit or losses at various levels of activity. The sales volume at which there is no profit, which we said earlier, here, the sales volume at which there is no profit or what? No loss is known as the what? Break-even point. It is useful, it is a useful method for businesses to assist in doing what? Estimating profits at different levels of activity. Right? So it's a very important number that every business has to know. Where do I break even? Because you have to plan around that number to mitigate against loss making. And of course, to promote profit making. The further you are above the break-even point is the more profitable you're going to be. Further below the break-even point you are is the greater your loss making is going to be. Here's a graph that summarizes the relationship between total revenue and total costs and documents the break-even point. When we're drawing a break-even graph, guys, which we will in Excel, we put sales. So sales here, you realize sales is on the what axis? Sales is on the y-axis.
Y-axis, Y.
So sales always goes on the y-axis, or revenues. Sales or revenues always goes on the y-axis for the break-even graph. And then, guys, on the x-axis, we have units or quantity. Units sold or quantity, anyone. Units sold or quantity sold. These go on the x-axis. You can say units or quantity, Q. So always remember that when you're doing a break-even graph, sales goes on the y-axis. That's the dependent variable. Dependent variable always goes on the y-axis, dv. Dependent variable on the y, the independent variable on the x. All right? So sales will be influenced by the level of production here. So sales on the y, production level, or units sold rather, or quantity sold on the x-axis. Can you identify here, class, what is the break-even point?
3 units.
3 units.
3 at 20 sales.
Very good. So it's going to be 3 units and $20 in sales. So the break-even point is 3 units. That's the break-even quantity. And at that break-even point, the company makes what?
No profit, no loss.
No profit, no loss. Exactly. So this is the break-even point. Excellent. So if the company is currently producing and selling 6 units, is it profitable?
Yes, sir.
Yes, sir.
Of course, quite profitable, right? Okay, let's look at the shape of these graphs. So we're assuming linearity, straight line relationships for simplicity. But know that in practice, the relationship could be nonlinear, which means represented by a curve instead of a straight line, okay? Now, if you look at this carefully, guys, you realize that the total revenue slopes upwards, the total revenue line here. So too does the total cost line. Now, the distance of the total revenue line above the total cost line represents what?
Profit.
Profit. So that you see, look at this right here. the distance of the total revenue line above the total cost line at different levels of production represents profit. When 6 units are produced, this will be the profit. The distance between the total revenue line and total cost line. That difference represents, that difference in terms of dollar value, which would mean that we would have to match the corresponding points on the y-axis. That difference in terms of dollar value represents the profit. Notice that every point, every unit produced above the break-even point is profitable, as represented by the green area. But every unit below the break-even point is represented by the loss area here in orange. Got it?
Yes, sir.
Yes, sir.
Yes, sir.
So for example, if the company produced 2 units, it will be making a loss. And that loss is represented by the distance between the total revenue line and the total cost line. So
Doc,
yes, go ahead.
so the orange is a loss and the green is a profit.
Correct. Because in the green area, total revenue is above, the total revenue curve lies above the total cost curve. Here. But in the orange area, oh, I just got what you're implying. I was a little slow on that one. I got you.
Politics, boy.
Yeah. I just got you. All right. I was a little slow off the blocks on that one. So
Doc,
yeah,
I remember doing a thing in microecon about the law of diminishing returns, where
that's right.
they were telling us like after the firm reaches a point where it producing and making a profit, if you add one additional unit, that
Yes,
profit starts to decrease and decrease and decrease.
correct.
And if you produce too much, then they'll end up back in a loss.
Correct. Very good. Very good. So you will study those specifically when you do econ, if you haven't done it already.
Yeah, man, we do microecon, but
Yeah,
we
as part of the MBA program here, you will have to do econ as well.
okay, sir.
So you will be revisiting those as well and expanding your knowledge on that. So yeah, so that's what this is showing here, guys. This is a break-even graph here. Come in, Richard. One thing to notice here with the break-even graph as well, guys, is that there's a fixed cost line and a variable cost line. Those really don't interplay in us identifying the break-even point. They don't. But you realize the fixed cost line is probably at about 10 here. It's fixed, right? It's a constant cost. It's a constant figure, regardless of the level of output. See? Regardless of how much is produced and sold, the fixed cost remains at what? 10. You seen that? Is everybody noticing that with the fixed cost? It's a horizontal line indicating one fixed number, 10, for example, regardless of the level of production. But what do you notice about the variable cost line? The variable cost line slopes how? It slopes
It's
upward.
parallel to the
Upward.
total cost.
And it's parallel to the total cost. That's a great observation. Two observations here about the variable cost line. Firstly, it slopes upwards, which means that as the quantity increases, so too does the. So this is both sales and cost in reality. Both sales and cost are measured on this line. Sales and cost, okay? Strictly speaking, not just sales, it's sales and cost on the y-axis and units on the x. What this is saying now for the variable cost is that the variable cost is sloping upwards, which means that cost is going up as we increase the level of what? Production.
Production, yes, sir.
So variable cost goes up as the level of production increases. Another critical observation is that the variable cost line is parallel to the total cost line. The total cost line takes the shape of the variable cost line because in the short run,
Fixed costs.
The only cost that causes a change in the total cost is a change in variable costs in the short run. Okay, guys, in the short run,
Can you repeat that, please?
in the
The only
short
cost.
run, the only cost that causes a change in total cost is variable cost.
Okay,
And that is why you realize that the total cost and the variable cost curves here, they are parallel. The total cost curve takes the shape of the variable cost curve in the short run. Because in the short run, the total variable cost, changes in variable cost is the only thing that can cause a change in total cost. Because fixed cost is what?
Fixed cost is constant. It don't
Constant.
change.
Exactly.
Constant.
Good, because fixed cost is constant. So because fixed cost is constant, the only cost that will cause a change in total cost in the short run is a change in variable cost. That is why the variable cost and total cost lines are parallel, and the total cost actually just mirrors the shape of the variable cost. But the total cost line has to be above the variable cost line because it also takes account of the fixed cost component. So that is why this total cost line lies above the variable cost line, because it also takes account of the fixed costs. Remember that there are two things that make up total cost, guys. Two things that make up total cost are what?
Fixed and variable cost.
Fixed and variable. So this total cost here has a variable component and also what? Fixed component. So therefore it has to lie above what?
The
The
fixed
variable
component.
cost. As well as above the what? Fixed cost.
Fixed cost.
But it takes the shape of the variable cost curve. Why?
Because the variable cost is a driving factor
The variable cost
in
is
the
the
short
driving
term.
factor. Brilliant. Variable cost is the driving factor for total cost changes in the short run. In other words, the only thing that can cause a change in total cost in the short run is a change in what, guys?
Variable cost.
Variable cost. Remember, variable costs are directly associated with production. Okay? Right. Everybody got that?
Yes, sir. I always look at it
Yes,
as
Doc.
like a car. I always look at it like a car. That's what I said.
Mm-hmm.
The more you drive distance, increase the gas. But it doesn't affect your insurance costs or some of these costs, but it affects your variable like a gas or oil or stuff like that.
Good. Excellent example. I like that example, Bennett. Brilliant. Everybody heard that from Bennett? So he's saying, the more you drive, it's the more in the short run, the more you drive is the more you'll have to spend on fuel. That's a variable cost. The cost of fuel will be directly influenced by the amount of money you spend on fuel will be directly influenced by how much you drive the vehicle, right? But you would have already agreed on the insurance premium for the year already. So that insurance premium might change in the future. You know, the insurance premium might change in the future. But for right now, no matter how you drive it, that insurance premium that you've already agreed to for the year will remain fixed. Correct? So that's a good example of a fixed cost versus a variable cost. Great. So let us continue now. Here's one of the ways in which we will calculate break-even, guys. Break-even point, BEP, and this is in units now, okay? Break-even points here in units, quantities, is equal to total fixed cost, a very simple formula. And I know accountants might have some alternative ways in which they do things. But what is articulated here is what is required for the course, okay? So break-even point is equal to the total fixed cost. That's what TFC is here, guys, total fixed cost, divided by, or all divided by, SP here is the selling price per unit. That's what SP here is, selling price per unit. And of course, VC is the what? Variable cost. So what is SP here? The selling price per unit. Selling price per unit. You know, just how much each unit of the product is sold for. That's it. That's SP. And VC here, VC is not the total variable cost, so it's necessary to clarify that VC here represents the variable cost for each unit, to produce each unit. So it's variable cost per unit. Are you with me, guys? Per unit.
So far.
And the total fixed cost,
sir.
TFC is just what? Total fixed cost. Got it?
Yes, sir.
All right, so TFC is total fixed cost. SP is what? Selling price per unit. VC is what? Variable cost per unit. Are you with me, guys? All right, so let's go. So break-even analysis, we're gonna apply that shortly. All you need to do now is to just be familiar with this formula and its composition. We're gonna get into some practical applications shortly, okay? Just understand the formula for right now. There's another way you should know from now. There's another way in which we can find the break-even quantity. It's an alternative way. It's to just set the total cost function. What do you think? Equal to what? Anybody can guess?
Revenue or sales?
Brilliant. Equal to total revenue or total sales. Well done. By setting the total cost function equal to the total revenue function and solving for the quantity, we can also find the break-even quantity, guys. That's another way in which we can find the break-even quantity. We don't want to get into that, Denton. So the total cost there is equal to what? The total revenue. If we can equate these two functions, we can equate the total cost function and the total revenue function and solve for Q, then that represents the break-even point as well. That's another way. And you will see both, of course. That's another way in which we can find the break-even point. Okay, guys? Just so you know from now, that's an alternative way of finding break-even. So one way to find break-even is what? Total fixed cost
Divided
all over
by
selling price per unit minus what? Variable cost per unit? Or we can equate what? Total cost and total revenue, which is the very definition of break-even, isn't it?
Right.
And then just solve for Q. So here's another important concept, margin of safety. The margin of safety is calculated by subtracting the break-even quantity from the actual or budgeted sales and then dividing by the actual or budgeted sales. The result is usually expressed as a percentage. Experts use this financial ratio called the margin of safety for break-even analysis and forecasting to assess the existing cushion. You can look at the margin of safety as a cushion. The existing cushion in actual or budgeted sales before a firm bears a loss. To calculate, I'll explain that some more. To calculate the margin of safety, we use current sales minus the break-even point. And this is all in quantities. I should make that clear. This is in quantities. Okay, guys? This is all quantities. All quantities. It's the current sales quantity then, we could say more specifically. Current sales quantity minus the break-even point quantity again over the current sales quantity. And normally we multiply this by 100 to put it in percentage form. You know that multiplying by 100 converts a number to percentage form, right, guys?
Right.
So what does the margin of safety tells us now? Let us say we apply this formula, guys. So we apply this formula and we come up with an answer of 20%. Here's how you would interpret this 20%. The 20% means that the company can afford, and I'm using afford a little loosely here. The company can afford to lose 20% of its current sales and still not be in a loss position. In other words, if the company's current sales declines by 20%, it will go to the break-even point, which is obviously not a loss-making point. So that's what the margin of safety is. It's like the buffer. It's the cushion that your current sales provide you over and above your break-even point. So if the margin of safety is 20%, it means that the company has a cushion or buffer in its current sales. Its current sales provides it with a buffer or cushion of 20% above the break-even point. You get the point, guys?
That's all your profit, sir.
You could say that. Yeah, it's like your profit. It's your profit zone. It's your profit zone in terms of quantities. That's right. It's your profit zone. Your margin of safety, but it is usually it's usually the profit zone, but expressed or looked at in terms of quantities. So again, what if your margin of safety is 5%? You can afford to lose what?
5%.
5% off what?
Current
Of your current sales.
sales.
And when you lose 5% of your current sales, will you be making a loss?
No profit, no loss.
No, you'll be making no profit nor loss because it will bring you back to what class? Break even. And this is how you calculate the margin of safety, guys. Current sales quantity minus break-even sales quantity all over current sales quantity. Come in. If that figure is 20%, it means that your current sales provide you with a cushion or buffer of 20% over and above the break-even point. So you can afford to have a decline in sales of up to 20% and still not be in a loss-making position. There were two questions coming through. Go ahead, guys.
Kind of safety, sir. If that can calculate at one point.
Brown, you came across a little choppy. Could you go again?
I'm saying mine of safety at different points.
Is anybody else hearing Brown clearly?
No, sir, not here at all.
Oh, we're not hearing her.
Brown, could you type it? I don't know if it's your location. Could you drop it in the chat if it's possible and safe to do so? You're not coming across clearly to us. Yeah, just if it is safe and possible to drop it in the chat, you could just do so, or when you are more stable.
Sir, can I go ahead then?
Go ahead, Constantine.
So, sir, is it safe to say then the margin of safety is really the break-even point?
No, it's the area above the break-even point. It's the area above. So, for example, let's say the break-even quantity was 10 units, but you're currently selling 20 units, right? So your break-even was 10 units, which means that you know from your calculations, from applying this formula, that the break-even quantity is 10, which means if you sell 10 units, you're not going to make a profit, but you're not going to make a loss either. But you know that you're performing at a sales level of 20 units. Then your margin of safety in raw numbers would be 10. The area between the two. In raw numbers, in absolute terms, your margin of safety is 10. You with me? So it is the distance that your current sales provide you over your break-even point, beyond your break-even point. If we were to calculate the margin of safety now, it would be 20 current sales quantity minus 10 break-even sales quantity divided by 20 current sales, which would be 50%, right?
Yes, sir.
50%. You see that, everybody? 20 minus 10 is 10, right?
Yeah, man.
Yeah, you see, 10 over 20, so that's 50%. What is this 50% now saying? That it's telling us, we could interpret what it's saying in a number of ways. Let me give you about 3. One, it could be saying your current sales is 50% above the break-even point. Speaking quantities again. It's also saying that you can afford to lose 50% of your current sales and still not be making a loss. It's also saying that in order for you to make a loss, your current sales would have to fall by more than what?
50%.
More than
50%, sir.
50%. Exactly.
Sir, so in
Sir.
retrospect, if you lose your 50%, you will be still at break even.
Yes, 50% exactly. Correct.
Okay.
But beyond that, you're in the loss-making zone. So every company needs to know what their margin of safety is. Every time, every minute of the day, you need to know what your margin of safety is.
Sir,
Yes.
I'm also assuming that knowing this margin of safety would help to guide companies as to what level of discount they can extend to customers and things like those.
Brilliant. Brilliant. That is it. That is now getting into the inference. That is now getting into the inference. I'm sorry, who just spoke again?
Doc, you came in a little bit choppy when you were Sorry. Doc?
Yeah, I'll go over for whatever you want. Who just spoke? Who just gave the answer to the question
Yeah,
just now?
I'm Caroline Letmon, sir.
Caroline, yes. Caroline, that's a very profound point. The company needs to know what its margin of safety is in order to, for example, determine sales deals that it gives, discounts, and to know the impact of certain decisions internally and externally on its profits potentially. You see, what can I afford to lose? What, as we would say, what wiggle room do I have? What wiggle room do I have to play with? That's what the margin of safety gives us. That's a really, really great point. All right, so someone was asking me to go over something now.
There's 3 points, sir. You came in a little bit choppy on my end, please.
Okay. I was saying now the margin of safety tells you a number of things, 3 of which are these. It tells you the percentage of your sales that you can afford to lose and still not be in a loss-making position. That's one. Percentage of sales that you can lose and still not be in a loss-making position. Right? It tells you as well that if your sales fall by more than the margin of safety percentage, then you'll be making a loss. And in a general sense, it just tells you the cushion that the company has, the cushion that its current sales level in quantities provides above the margin of safety. I mean, all of those can really be melted into one neat statement, you know, but just to flesh it out a little so you understand the perspectives.
Sir, good afternoon. I have a question here.
Go ahead, Nadine.
Natalie.
Yes.
Okay, sir.
Go ahead.
The conversation so far is very interesting and I am following.
Great.
But for me, it would be if you're in a business that maybe sells something or you're in it for profit. However, as a public servant, I am specifically in delivering service.
Yes.
And I know earlier you made mention that even within non-profit organizations, we talk about efficiency.
Correct.
I am particularly interested in getting an example specifically for service-oriented industry. How is it that we use this to make our service delivery more efficient?
All right. Thank you for that question. To be frank, the margin of these concepts that we're looking at here right now really center around profit-making entities. To be very frank, these particular concepts surrounding break-even really, although ideas from the concept can be translated, you know, or creatively used in other applications, which I will mention in a minute. Strictly speaking, what we're looking at now is for profit. Is centered around profit. That's why we mention things like your total revenue, your total costs, your variable costs, etc. But although the focus that we've been emphasizing so far is on profits, right? You might work for a service organization that collects revenue, right?
Yes, sir.
Okay. And also incurs
Yes.
costs,
Yes, sir.
both variable and fixed. You're not going to be you're not selling anything in the strictest of sense. So as far as sales is on the y-axis, you will not have sales. You could just have dollar value, for example, right? And let us say you're analyzing, you're trying to analyze to determine. Again, I need to also add that not only would you not have sales here, but you wouldn't have units sold on the x-axis, which is why I'm making the point that what we are focusing on here so far with respect to break-even analysis is really for profit organizations, organizations with a profit motive, right? So your question is a very good one, but I just want to make it clear that the focus so far with this break-even analysis as a whole is really centered around profit and loss making. But the ideas can be translated, right, or creatively used in other areas. So for example, you could say, let's use an organization like, I would say, let me think of a government organization.
Like customs, sir? Where total revenue, although the revenue that we collect is not our own, it's central government.
Yeah, all right. Let's use customs, for example, then.
Put number of barrels on the x-axis.
Good. Exactly. So like with customs, you could say, all right, you're going to have a total revenue. You're going to have an operating cost. And you could, for example, try and determine at what level of barrage, what level of cargo handled, yes. At what level of cargoes handled, which would be on the x-axis, with dollar amount, with revenues on the revenue and cost would be on the y. You'd have revenue and cost on the y, and then you could have cargo handled on the x. At what number of cargoes handled would total revenue be equal to total cost? You get that point? So we could say, okay, if this was the case, you could say at 3 cargoes handled by customs, total revenue equates with total cost. And any number of cargoes handled beyond that, then customs is making a surplus. You wouldn't use the term profit. You just use the term surplus. You would use surplus and deficit. For non-profit organizations, it wouldn't be profit and loss. It would be surplus and deficit. And it wouldn't be sales on the y-axis. It would be like just revenues and cost. And on the x-axis, you could just have units generally, which is just, which would be very depending on the organization and what you're trying to model. You're trying to determine at what level of barrels or containers handled total revenue equal total cost, and that is break-even point for the organization. Do you get that point?
Yes, sir. Yes, sir. Coming back to service, though, sir, I'm kind of seeing where some persons sell service. For example, a lawyer or and clients.
Yes.
And
okay. So for us, I'm sorry. Go ahead. Complete your thought.
Yes, sir. I was just thinking like you have an office and you have a business, but in terms of the amount of clients.
Good. Exactly. Brilliant. So for example, you could say at a certain number of clients served in a given period of time. So that could be like your x-axis value. At a certain number of clients served, the total revenue will be certain amount and the total cost will be certain amount. If they are equal at whatever number of clients served, the total revenue and total cost equate, and that's break even for that organization. That's where the total revenue equal total cost, and there's no surplus nor deficit. So you wouldn't use the term profit and loss. with like a government service organization, you would use the term surplus and deficit instead of profit and loss. So you could say, okay, at a certain number of clients visiting the tax office or served by the tax office for the year, total revenues equate with total cost. That's break even for the tax office. Where number of clients served would be on the x-axis and revenues and costs would be on the y.
Or it could be, sir, the number of transactions done.
Or the number of transactions, correct. Could be on the x and the revenues and costs on the y. And where the revenues, the number of transactions at which the revenues collected equate with the costs is where the organization is breaking even. You get that? I don't know. Hopefully government organizations do this kind of analysis because it's still relevant to them.
So we're coming back to decision alternatives then, sir.
That is right.
In terms of what model you use, depending on the choices that you're looking at.
Depending on the specification of the model. That's right.
Yes. So
that's right.
In some instances, it would be you would probably get a better result if you use number of clients served.
Very well.
Maybe if you use number of cars cleared or the number of,
Yes, sir.
So it depends on what information you are trying to ascertain from doing it.
Very much so. Excellent point. So, what was it, Lambert, that asked the question?
No, sir, it was me, but
not Dale,
I guess it's a little clearer now in terms of how it would affect my service delivery. Thank you.
Yes, okay, Nadil, no problem. Good question. Very, very practical question there. Very practical question. So, with service organizations, just think of surplus and deficit instead of profit and loss. On the y-axis, it's revenue and cost versus sales. And on the x-axis, units could be like number of transactions or number of customers served. Come in, Craig. Or number of containers or cargo handled, just depending on the organization itself. But just know it's units on the x. And units can be operationalized in several different ways. And revenue and cost on the y. Go ahead, Craig.
Right. I just wanted to find out from my colleague if when she said service industry, is it that she is in a non-profit industry, or is it that her organization offers a service at a profit?
Nadale, do you want to respond to that? That's a good question.
Okay, so we offer service definitely to the public, but you do pay for it. So I guess in some way making a profit from it, we can only enhance from its revenue.
So the reason I ask, because what service?
Service. Everything is not given to you free. So you have to pay for the service. But it is not to say that it is strictly profit based.
Okay, I understand.
Got it. Got it. All right. Excellent discussion, guys. It's very, very potent contributions there.
One thing though, sir, you mentioned the margin of safety and you pointed out three things we can know from it. What was the third one again?
Let me just say over all of them, right? Let me just look at the comments section
Percentage of
quickly.
sales you can afford to lose.
Percentage of sales you can afford to lose.
Know when you're making a loss.
Without making a loss. What else do you have there?
Knowing when you are making a loss. Can tell you when you are making a loss. And the third one that I didn't catch it.
All right, I think with the third one,
I got disconnected. Sorry about that. So I'm not sure if I answered the question that was asked.
Nadale?
Yes, I got disconnected. Yes, I got disconnected.
I think you're good. We're satisfied with your answer.
Okay, all right.
Yes, that's right. Okay, so the margin of safety tells you what percentage a company can afford to lose from its current sales and still not be making a loss. It tells the company above what percentage of loss in sales it will start to make a loss. And it gives an impression of the cushion that the current sales level provides over and above the break-even point. The cushion that the current sales level provides over and above the break-even point. Another very important piece of parameter here is the contribution margin, guys. This is computed as the selling price per unit, SP or just P, minus the variable cost per unit. Also known as the dollar value contribution per unit. This measure indicates how a particular product contributes to the overall profits of the business. So this is another very important thing that every company must know. Contribute. Every company that is involved in offering a particular product, selling a particular product, or offering a particular service, you need to know what is the contribution margin. If it is not a profit-making company, you would use selling price per unit. You would use revenues per unit. For example, revenues per transaction, revenues per barrel, or revenues per cargo handled, revenues per client served, sort of thing. So the contribution margin here is the selling price per unit minus the variable cost per unit. For profit-making organizations, or it could, for a non-profit organization, it could be revenue per unit minus variable cost per unit. And this tells you the dollar value contribution that each product or service offered makes to the overall profits or revenues of a company. So the contribution margin is just the selling price per unit minus the variable cost per unit, guys. Everybody understand what it's telling us? So a company might have 10 products on its fleet. A company might be selling 10 products, right? It wants to know what is the contribution margin for each of those 10 products. In other words, what is the contribution that let's say a company, let's take Red Stripe as an example. Red Stripe sells Red Stripe beer, light beer, and flavored beer, right? Red Stripe beer, that's a traditional fat bottle. We have Red Stripe beer, flavored beer, and light beer. Let's say those are the only 3 products that Red Stripe was selling. Red Stripe needs to know for every bottle of beer, Red Stripe beer, that's a traditional beer. For every bottle of the traditional beer sold, how much does that contribute to profit? It also wants to know for every bottle of flavored beer sold, how much does that contribute to profit? And it wants to know for every bottle of light beer sold, how much does that contribute to profit? It could be that the traditional beer has a contribution margin of $5. We're going to interpret this. It could be that the flavored beer has a contribution margin of $2. And the light beer has a contribution margin of $1.50. What this will be saying to Red Stripe is, listen, well, it could say a number of things, but on the face of it, as far as the contribution margin is concerned, this kind of data would be saying to Red Stripe that they get more as far as profits are concerned out of every bottle of traditional beer sold compared to flavored beer or light beer. Do you get me, everybody? It's telling you how much each unit of product that you have in your fleet sold contributes to profit. It might be cents. And so this now is very critical for decision-making purposes as well. For non-profit organizations, it could be how much each service offered contributes to revenues on average. And so from a service standpoint, this is also, the contribution margin is also